Hello and good morning, everyone. Welcome to another episode of the Market Snapshot series. My name is Rufus Kamau, Markets Analyst at FX Pesa. So today we'll be talking about the top events that are currently moving markets, ranging from last night's FOMC press conference, the Fed rate decision, and the expected Bank of England interest rate decision. So once we cover the top events, we also be doing some technical analysis, try to understand the prevailing market patterns and where the charts might be headed next. And as always, remember that this session does not constitute of any form of investment advice. It is not a recommendation to trade, so you should always do your own due diligence. So once you join in, kindly say hi on the live comment section. You can see Joseph Mutiga is already in the house. Good morning and shout out to you for being the first person to join in comment. Kay is already in the house commenting about the FOMC. So we all know it was the biggest event in the house so far this week. You can see Teresa FIFA in the house, Justus Chalo. Thank you for joining. So let's get on with it. So the key highlights as per last night's activity were one, and as you can see on the linked website here, this is Forex Factory. Trying to make it bigger. So Jerome Powell basically said that there is no widespread support for a 50 basis point rate cut today. That was last night, and no need to move quickly. Waiting was the right call. So this was the first rate cut this year after the last one happened in December last year. And the market had largely priced this 25 basis point rate cut. So we didn't expect any surprises. There was a 96% level of confidence or probability that the Fed would go for a 25 basis points rate cut. So we'll be looking to understand how the markets reacted to that. And once we cover that, hopefully everyone will trade from an informed perspective. So other than that, we'll be looking at other key highlights or updates based on last night's Fed decision. So let me share a different screen here. So this is Telegram, and what we are looking at is the bullish banter community. So I had made some updates earlier. So I remember last week I mentioned that the bullish banter community now is live, and we can participate in conversations about markets as well as episodes of the Bullish Banter podcast. So the point I want us to focus on is the summary of the Fed Chair Powell's speech last night. So the one key thing he highlighted is that unemployment rate has risen along with downside risks to employment. So this is following the unemployment rate increasing in the last non-farm payrolls. So at the same time, we saw downward revisions for the year ending March 2025. The BLS, or the Department of Bureau Labor Statistics, revised the previously reported jobs down by 911,000. So on top of that, in July, August, we had revisions amounting to 250,000 jobs downwards, which means that the job market in the US is a bit shaky than expected. So inflation has risen and remained somewhat elevated. This was evident in the last consumer price index data from the US. So with inflation remaining above 3%, that is somehow or somewhat challenging, though there was a slight drop to 2.9%, but core remained at 3%. So growth in economic activity has moderated, meaning that the economic growth in the US economy is slowing down. Job creation rate is below break-even rate to avoid rising unemployment. So this basically means that the number of jobs available in the US economy versus the number of people looking for for jobs has basically inversed, meaning that there's more people looking for jobs compared to the jobs available, and this is usually a red signal. So near-term inflation expectations have moved up on tariffs. So tariffs has basically driven inflation expectations higher, and effects of tariffs on economy remain to be seen, meaning that there will be more development. For instance, today Trump is in the UK and he's set to meet the UK Prime Minister Keir Starmer, and of course they'll be doing a press conference together, and that has the potential of moving the markets today. So the Fed was clearly forced to cut rates due to a weak labor market. So that's basically the summary of what happened last night, and we'll be looking at the charts later to understand what transpired in the charts and how the markets reacted to that. So other than that, there was also the release of the Fed's dot plots. So this is plots or projections that are presented by the Fed members, Fed voting members. And as per the dot plot, most important thing is that in 2025, we are expecting interest rates to drop to 3.6%. And that's somewhat around a mid-range between 3.50% and 3.75%. So this means that the Fed members are expecting that there will be two more 25 basis points rate cuts before the end of the year. So that's why the markets reacted the way they did, with stocks at first initially dropping, but eventually recovering and pushing towards new highs. Gold had a bit of a sell-off, but this morning we are seeing some bit of recovery. So clearly the market is taking the rate cut positively. So the dollar happened to be very strong as of this morning, but now we have started seeing some signs that it's going back to where it was, that is towards some further weakness. So if you'd like to join the community, I'll be sharing the link in the comment section. So just give me a sec. So the link is right there in the comment section, and we'll be having more and more updates and trade ideas. So hopefully you get to benefit from the community. So if you have joined the community via the link, kindly comment or respond on the comment section here. All right. So let's get back to the calendar. So as of this morning, we had GDP data coming in from New Zealand, where the economy contracted by 0.9% in the second quarter of this year. And these missed expectations of a 0.3% contraction, and it was way different compared to the 0.9% growth experienced in the first quarter of the year. So this was a bit surprising. It came out at 1:45 a.m. and it led to an increased sell-off of the New Zealand dollar. And if you check your charts, you'll notice that among the major currencies, the New Zealand dollar has been the weakest since the day started. So for the Australian economy, unemployment change was even worse. We saw employment change being negative 5.4K, meaning that the economy lost 5.4 thousand jobs rather than a net increase. And then the unemployment rate remained the same at 4.2%. So trade balance in Switzerland was 4.01 billion Swiss francs, which was lower than the previous reading and lower than the expectation, basically meaning that the trade in Switzerland is worsening. So on the other hand, we had the current account in the Eurozone, which is also the trade balance, the difference between exports and imports. So also the Eurozone missed the current account data, in this case, reporting 27.7 billion euros, which missed expectations of 34.6 and lower than the 35.8 billion euros reported in the prior report. So the main event of the day today is the interest rate decision by the Bank of England. So they'll be releasing a monetary policy summary, an MPC or Monetary Policy Committee official bank rate votes. And the expectation today is that 8 members vote to hold interest rates steady. 1 member votes for a rate cut and 0 members vote for a rate hike. So the overall consensus is that the interest rates will remain the same at 4.0%. So why is this expectation there? Why is the market expecting that the Bank of England will be holding rates at 4%? Well, there's quite a number of data points. So on one side, if you look at the United Kingdom GDP annual growth rate, you'll notice that growth has been stagnating somewhat. So, for instance, if we look at the past 5 years, of course, this is an outlier because it was a jump right of COVID lockdowns. Then growth remained elevated in Q3 2021 at 9.4%. Then we got 9.5, 11.5, but since then growth kept going down up until in Q4 2023 when we had a negative 0.2%. So since then, we have seen 0.7, 1.1, 1.2, 1.5, 1.3, and then 1.2, meaning that now we are seeing growth slowing down compared to the pace we had seen in the fourth quarter of last year. So this year, in our first quarter, there was a reduction to 1.3%, then second quarter 1.2%, meaning that the level of economic growth in the UK economy has been slowing down. So when you look at other data points, for instance, the unemployment rate was basically lowest right after COVID. So remember, it moved from 5.3% at the height of COVID lockdowns. And then people went back to their jobs and unemployment rate dropped to 3.6% in August 2022. So since then, it has been a consistent trend of unemployment rate rising, with the most recent report indicating a 4.7% unemployment rate. So you don't want unemployment rate to be rising this fast in your economy. And whenever this happens, it becomes quite a problem, especially for the central bank, since they have to ease conditions in order for them to see the job numbers rising. However, easing conditions is not always a smooth curve, meaning that if unemployment is rising, you expect the central bank to cut interest rates the same way we saw the Fed do last night. But then you risk putting the economy in jeopardy if the level of inflation is on the rise. So while US inflation has stabilized around 3% somewhat, we saw UK inflation rising from 2% and moving all the way to 3.8%. So in the last 1 year, for instance, in September last year, the level of inflation in the UK economy was 1.7%. So this has been consistently moving higher, and as per the last report in August, UK inflation was at 3.8%. So you don't want this kind of growth in inflation, and in these kinds of conditions, it's not wise to cut interest rates. So while the weakness in the labor market supports a potential rate cut, the increasing inflation is not something to work with when it comes to cutting interest rates. So that's why there is an expectation that the Bank of England will take a cautious approach and consider holding rates steady rather than going for a rate cut, and then wait for a few more weeks to see if inflation moves back towards 2%, and then that would provide the right environment to consider rate cuts. So other than that, looking at other news in the markets, tomorrow we'll be having an interest rate decision by the Bank of Japan and national core CPI data still for Japan. So we expect consumer price index to drop to 2.7%, that is core, which basically excludes food and energy prices, whereas the Bank of Japan is expected to hold interest rates steady at 0.5%. So the reason I'm mentioning this is because it will be coming up early in the morning, so that will be before the next market snapshot. So for those who are new or are here for the first time, you should know that these sessions happen every day from Monday to Friday at exactly 11 a.m. So with the Bank of Japan expected to hold interest rates steady at 0.5%, the key focus will be on the monetary policy statement and mainly the Bank of Japan press conference. So if the BOJ, let's say, suggests that they will be doing more rate hikes before the end of the year, then that will likely propel the Japanese yen higher. So we could be seeing a very strong trend in the Japanese yen as of tomorrow and perhaps extend that into next week. So as for today, the main focus is on the UK pound, and the expectation is that if we see the Bank of England holding interest rates at 4%, and if they highlight a cautious approach, then that would mean that the UK pound strengthens against other pairs. And given the dollar weakness, the pound USD pair could be a favorite for the day, meaning that you'd be trading one strong currency against a weak currency. But then, as I mentioned earlier when we were starting this session, GDP quarter over quarter being down 0.9% in New Zealand makes the New Zealand dollar the weakest currency in the markets as of today. So what this basically means is that if we happen to see a very strong pound, then pound New Zealand could be an easy target because we are looking at one very weak currency versus a strong one, but also pound USD could be a currency pair that you would want to consider. So remember, this is happening at 2 p.m. So make sure that you are alert and you don't miss a single update. So other than that, looking at other things happening in the markets, as per the currencies, notice, as I mentioned, the New Zealand dollar has been the weakest, down almost 1% against the USD. The Japanese yen is down 0.27%, Australian dollar 0.22%, and those are the main losers. Whereas we have seen in the past couple of hours, the euro and the GBP regained territory that they had lost yesterday, and now they are slightly up against the USD, and we expect this trend to continue for the day. So we expect the euro and the pound to resume their bullish momentum. So if you look at the weekly performance, the Swiss franc is still the best performing currency of the year, and this week it's still the best performing currency against the USD. That is among the major currencies. So the euro, the pound, the Canadian dollar, and JPY are all up against the USD for the week, whereas the Australian dollar and New Zealand dollar seem to be the weakest so far this week. So as per the stock side, we had a pretty good response from the Fed decision yesterday. So the markets were largely bullish. One of the key highlights yesterday was that China banned its companies from buying NVIDIA's chips. So as a result, we had an underperformance in NVIDIA, but largely the rest of the tech sector was mainly doing well, or rather the SP 500. Almost all stocks were making some good gains yesterday. So this means that the stock market is taking the rate cut positively, and that is expected to continue within the markets today. So another take on what transpired yesterday was from Wells Fargo, where they said that the September FOMC was a risk management cut. So as expected, the FOMC reduced the Fed funds rate range by 25 basis points to 4 points to between 4% and 4.25% at the conclusion of its meeting today, the first adjustment in 9 months. Newly confirmed Governor Stefan Miran was the lone dissenter at the meeting, preferring to cut by 50 basis points instead of 25 basis points. So clearly here, we can see Trump is winning now that the Fed has a new nominated member. So while the rest of the members have been working closely with Powell and they were considering 25 basis points, the new member was going for 50 basis points. They wanted rapid rate cuts. So the decision to ease reflected a shift in the balance of risks, with the committee believing that the downside risk to unemployment have risen. While inflation has ticked up since the spring, development acknowledged in the post-meeting statement, job growth has downshifted sharply and the unemployment rate has risen to the top end of the committee's central tendency range, consistent with full employment. So amid increased concerns about the job market, the median projection for the Fed funds rate at the end of the year edged down by 25 basis points to 3.62, indicating an additional 50 basis points of easing over the course of the FOMC's October and December meetings. The median projection for 2026 dipped to 3.375%, more easing this year. The median estimate for the long run, or the neutral Fed funds rate, was unchanged at around 3%. So those are the key highlights as of this morning. Any other key highlights? So from trading economics, key highlight is, of course, Fed cuts rate as expected. Australia job rate holds machinery orders drop sharply in July. So I don't think there's anything new there. It's things we have already discussed. And lastly, so other than that, looking at the earnings side, the one key highlight company that will be reporting earnings today is FedEx, which will offer a window on economic activity when it reports fiscal 2026 first quarter results after Thursday's closing bell. The logistics giant will down more than 18% year to date, even as industrial stocks have rallied near 16%. So clearly, FedEx being down 18% is a big concern. So the earnings will inspire either confidence or panic in the markets based on the numbers and, of course, the earnings call where they get to discuss various activities about the company as well as projections for the company. So that's it from the economic side. And now I believe we can jump straight into some technical analysis and try to understand where the markets might be headed next. So before I progress, let me check on the comment section, see if there's any questions or comments. Thank you, Justus Chalo, for joining the community. There's a question on BTC. We'll check on that. So it's a bit crazy that the UK rates currently at 4%, but yield is above 5%, which means they're still borrowing at very high costs. Yes, that's quite a concern. It's not just the UK, it's also France as well as Germany. They are going through these challenges as European nations. And whenever you see yields pushing above 5%, basically means that investors are basically just dumping those bonds. They don't want anything to do with those bonds. Main reason this is happening is because of the near term they cut interest rates, then the bond, the return on bonds tends to go down with it. So in this case, looking at yields above 5%, it's basically investors saying that we are not buying your bonds. So comparatively, I think this is the best uh, performing year for gold in a long, long time, perhaps even 100. So now that gold is up for 40%, means that a lot of investors would prefer holding on to gold compared to holding on to bonds of major economies. So what did this statement mean? The committee will continue reducing its holding of treasury securities and agency debt and agency mortgage-backed securities. How significant are these holdings? So this has been a long-term process. It began during COVID. So during COVID, there was a lot of panic, especially for mortgage-backed securities. That it was openly buying mortgage-backed securities as well as treasuries in order to support the economy and make sure that the market. After accumulating a whole lot of this is pushing these assets back in the market bit by bit. So it's basically selling them back to the market bit by bit in order to reduce the balance sheet. So that has been the consistent thingy. So it's gradual. It's not something that is happening like instantly. They want to slowly put these assets back in the market. Could we analyze the dot plot and make inferences to future price? I think I already did that. I just highlighted the dot plot. So the idea is pretty simple. The FOMC members are expecting two more rate cuts this year, and that's unless something changes. Let's say in the data, something like let's say GDP or inflation reports or NFP, then they are most likely going to follow their dot plots, which basically implies that there's a very strong likelihood we'll see another 25 basis points. Right. So that may explain why we are seeing stocks resuming the bullish momentum, gold finding some good level of support, and also we have seen the dollar resuming some earlier weakness. So another one, so they said inflation in the US is steady. That's why the Fed cut rates. CPI year over year for July was 2.7%, but August came higher. I don't see where it's stable. So inflation in the US has averaged around 3% throughout the course of the year, and that kind of signals stagflation. So this explains why the Fed has been refusing to cut interest rates. However, with the job numbers we have been seeing, it shows a very, very strong weakness. And if you remember last year in September, when the US decided to cut rates for first time since COVID, mega rate cut was because unemployment is in. So this tends to be the same approach that they are using. So unemployment rate is a big Fed mandate. It's their secondary mandate after stabilizing prices. So in this case, as they already mentioned, it's about the job market, not about inflation. If the job market wasn't worsening, then they would most likely not go for it. So do you think that DXY will continue declining if the situation remains as it is, like if no more interest rate cuts? Well, there's still a sell America trade. A lot of investors are avoiding the volatility that is coming in with Trump's policies. So even though it's the trade is thin, when you compare that with what's happening with US interest rates, as long as they are coming down, we'll be expecting mortgage rates to be going down, bond deals to be going. more money going into stocks. We could be seeing the dollar remaining weak. So I've seen a comment on my signal saying it's somewhat poor. I don't know. Would you confirm right now if it's still okay before I progress further? Can you hear me clearly? All right, got a response from Smith FX. He says he can hear me clearly. Okay, thank you guys for the feedback. So let's get onto the technical analysis. This is my favorite part. So this is the Netherlands stock market index, and since trading in this channel on the 4-hour, we had a breakout earlier in the week, a pullback which retested the breakout point, and now acceleration. And of course, we all know how this plays out. So whenever you have such a performance, you expect the market to rally to the next available resistance. And in this case, since we already broke this previous resistance here, so we could be seeing an extension to 927 and a potential extension to the beginning of the trend, which is around 934. So this seems like a book pattern to me, a no-brainer. So we have seen this play out again and again. So hopefully this one plays out as expected. So that's something I wanted to highlight for the traders who prefer trading indices. So for the UK 100 index, we've had a big sell-off late last week and early this week. But since I would say yesterday, we have had a pretty good bounce and we are seeing some good recovery. And we could be seeing an extension to this, especially after 2 p.m. after the Bank of England decision. Then for Japan, we mentioned that there are no candlesticks on the left. If you're looking for candlesticks on the left, they are way too far. So, actually, we don't have any. This is a new all-time high for the Nikkei 225 index. So we have been tracking this consolidation for the last couple of days. And as of this morning, we had a break. And this means that now we expect an extended momentum upwards. So for USD JPY, we had a big sell-off yesterday. Notice the sell-off and the breakout. But then immediately after the FOMC, we saw the dollar bouncing and regaining some territory. And now it's right back above the trend line, which had been serving as support for some good time. So clearly, the dollar is strengthening. And if you confirm with the dollar index, this has been the trend of the day. So since yesterday's big sell-off and recovery, as we enter the London session, this is the big change that's happening. The dollar index is now weakening. So now, judging by this and going back to the USD JPY, and knowing that tomorrow we're expecting a decision by the Bank of Japan, then it's most likely that we could be seeing the market breaking the lower trend line and moving lower. In this case, I would say in line with expectations that the Bank of Japan may promise further rate hikes. So here we are looking at a key level trend line, a resistance area. And then from the forward chart, we're looking at a support area that has been supported several times in the market. And now we could be seeing some form of resistance playing out here. So if this plays out, then the idea is to look for short selling positions, targeting yesterday as well as the previous day's low. So for USD trading against the Swiss franc, we have mentioned several times that the Swiss franc has been the strongest major currency of the year. So after the FOMC yesterday, there was a sharp drop here in the dollar against the Swiss franc. Dollar recovered and kept going up during the Sydney and Tokyo sessions. So we go to a key level resistance. Notice that this was the previous bottom here, now turned into a resistance. And immediately we go to that price action area, you can see that the market started pushing back down. So in this case, we should be looking for potential entries towards this direction, targeting yesterday's low. So Euro USD had the same kind of impact. At the announcement of the 25 basis point rate cut, a big jump up. Then the FOMC press conference, it went all the way back down and extended even lower. But then as we enter the London session, this is what we are experiencing in the markets right now. And this basically means that the euro is now bouncing again. And from a technical perspective, this was the upper trend line, serving as the resistance. So the market broke above the trend line and retested the trend line and is now pushing higher. So the idea is to trade the continuation and a journey towards yesterday's high. So expect the Euro USD strength to continue. Euro has been one of the best performing currencies since the year started. So almost a vertical momentum since January. So I don't expect that anything has changed. So we continue seeing the Euro being a strong currency. So as for the pound, we mentioned that we could be seeing something playing out. So notice how yesterday, after the FOMC, what we experienced was a big jump up and then a big shift down. Today, an extended shift even lower. But now, as we enter the London session, what we are seeing is a very strong bullish momentum on the 15 minutes and 1 hour time frame. So at least two targets. We have the Tuesday high and then the Wednesday high. So we should be looking at the market at least hitting this area here and then potentially extending the momentum to yesterday's high. So for AUDUSD, also here we are seeing a key level of bounce. So in this case, what we are seeing here is the market looking to reclaim the highs that we had seen yesterday during the news announcement. So it's a pretty good bounce here on the 1 hour chart, a proper bullish engulfing. So on the gold side, we already headed there. So from the 15 minutes chart, notice what happened. So I want to put some more focus. So what happened yesterday was nothing short of normal news. So whenever you have big news, especially in the US, the markets can react like this. For instance, yesterday, the markets shot all the way down here to that is 651 price level, and then shot all the way up to that 707. So this was quite a big range, if you ask me. This is a range of what? 564 pips, and this is within the span of a few minutes. So when this happened, of course, a lot of buy orders were triggered because gold had hit a new all-time high. So the highest price gold has ever reached in its history was here, and this was on Tuesday, that 703. So yesterday, if you had, let's say, buy stops above that 703, they were triggered, and then the market went straight back down. Session low, that was triggered too, and then the market got right back to where it's. And then during the FOMC press conference, we saw a gradual drop all the way back to the previous low, triggering the previous stops that were here. So this can be a common scenario in our news events. Stops are triggered here, and then the market moves up. Up, you buy, again goes down, you sell. Now notice how we had a break of these support areas here. Market signaled it down and then bounced immediately, and now it's pushing higher. So that can be a very common scenario, especially after these kind of events have happened in the markets. And in this case, so pullbacks are taken positively as potential entry points for further bullish momentum. So in this case, for gold, I expect further bullish momentum, and any pullback, I'm personally taking that as a potential entry points. So you can already see that some form of pattern was already shaping, expecting to see a very strong momentum upwards. And on the 1 hour time frame, what we are seeing is one very strong green candlestick overlapping the previous one, or basically engulfing the previous one, which implies a very strong entry by buyers who are looking to push price back to where it had started yesterday. So in this case, gold targets for gold is not the new all-time high. move on that is 686 price level. So I expect this bullish momentum at 686. So silver on this particular trend line, we just bounced from the same area, and if I was to move all this other noise, then it would be clear to you guys that silver is bouncing on that trend line and nothing is stopping it. This action on the 1 hour time frame is evidence that buyers are coming in heavy, which implies that we could be seeing this move extended. So we can't rule out another retest of the same trend line, but since we've already had it 3 times in 2 days, good chance that we see the market pumping from there since we don't have any other major news. So on the oil prices side, here all we are seeing more bullish momentum. Of course, we mentioned that last week when you are seeing this, we should be looking for a short selling opportunity, which happened on Thursday, and then Friday pump again, and then a drop. Monday, Tuesday we extended, Wednesday a drop, and today being last day, see like we are pushing even higher. So the idea long term during the London session, and this is attempting to push towards yesterday's highs, but then there is this area here that was active target area. It's very short, so we could be seeing the market stalling around 67.913. So UK 100, UT 100 or the Nasdaq has just broken into a new all-time high. It completely ignored everything that was happened yesterday. So notice how we had a big sell-off, then towards midnight the market recovered. So today it's just a pump. The market is not stopping. There are no candlesticks on the left. It's just moving higher and higher. So US 30 is the same thing. It was the biggest dragging index, and it was not forming new highs. But today it has broken into a new high and it's just pushing higher. So today is a green day for US equities. SP 500 just pumping higher. I don't know how high it will go, but there's a very strong likelihood that today is going to be a very good and green day. And this is considering that markets are now absorbing the expectation that there will be 2 more rate cuts before the end of the year. So BTC is still pushing as we had projected. So after breaking this particular trend line, we pushed through several targets. And now after finding resistance here last week at 116,629, now we are on a push on a course to push for the next level, and the next level is 119,154. So other than that, you're looking at European equities, starting with the German stock market index. After the a bit of a sell-off on Tuesday, we are right back in pattern. And notice how our range has always been. The target here is 23,878, which is the resistance. So we expect the market that now it's back in it goes right back to the previous resistance. For the EU 50, we should be tracking the previous high. This is the previous high that we had seen on Tuesday. So 54.50 in the near term, and if we break above that, then we move to the next available resistance at 54.88. So stocks even across Europe are also strongly bullish. So the France 40 stock market index clearly pushing to its previous highs. So targets around 79.35. Swiss 20 stock market index also bouncing pretty nicely. So we could be seeing a retest of this area here around 1200, and Norway we should be looking at the previous high. This is the weekly high around 1585. So we have already discussed the Netherlands stock market index, and it's already pushing. So near term target was 927.53, and we could also be seeing an extension to 934.33. So I'm just checking on more comments in the comment section. So Powell mentioned job market weakness, but the unemployment rate hasn't shown a significant rise, unlike PCE moving above the target of 2%. Well, when it comes to job market weakness, it's not just one data point. As Powell mentioned, the Fed basically looks at a cluster of data points coming in from the job market. So it's not just the unemployment rate. They look at the number of job advertisements and the number of people looking for jobs. They look at the unemployment claims, and all these factors now combined into one cocktail. Then they are able to decide whether the job market is healthy or not. So in this case, it wasn't about the unemployment rate, but the job revisions that we had seen over the last couple of months. So good question here. Red folder unemployment news. So in my experience, the unemployment claims is a weekly data point. And when you have other bigger news happening at the same time, those bigger news tend to take more precedence. So in this case, I would be more focused on the Bank of England as well as the Fed's rate decision last night compared to the unemployment claims. So a weekly data point which doesn't change with a big variation per week tends to be much weaker in influencing. So last question I'll be covering here. What do we expect coming weeks after rate cuts? So after rate cuts, of course, we know what follows up. We expect the stock market to be running into a new all-time high. And if we see new all-time highs dominating the market this month of September, then that basically means that we should be looking to see some level of profit taking happening later. So God damn, I'm trying to share myself. Why would I do that? Yeah. So as we approach the end of the presentation, I want to highlight a couple of resources, especially for beginner traders. So if you're a beginner trader, make sure to check out the FX Pesa YouTube channel. Scroll through the channel until you find the novice to pro trading course. You can click playlists, then scroll, then look for this novice to pro with Rufus Kamau. This will help you get started. 10 straight up episodes that get you from introduction, what is Forex and how to trade. Then if you enjoy these sessions, they are recorded live. They are available on FX Pesa YouTube. Just click on live. You'll be able to see today's session. This was yesterday, the previous day, and the previous day, and so on. So this way you're able to identify all the sessions that happened before that. And as per the podcast, remember, we have new episodes coming up every week. Appreciate you guys engaging with the podcast and giving us some feedback. So in the last episode, we hosted Stella Soake, an economist, and we had a lot to talk about global financial markets. We had a lot of comparisons between investments in Kenya versus the US, and these are the insights that help us build the next generation of investors. So that's it for today. Thank you very much, everyone, and I hope to see you on the next session. Good question. Oh, sorry. Why doesn't the Fed give forward guidance? Guys, the Fed.plot is literally forward guidance. The speeches that these guys do before they do an FOMC meeting, they are mostly forward guidance, basically building expectations that this is what we are most likely to do. So of late, I believe in the last 4 or 5 years, we have only had 1 or 2 surprise Fed decisions. In most other cases, what we have been seeing is things being expected in the market, mainly because the Fed was giving forward guidance. So that's it today. Thanks everyone. I hope to see you on the next session. Remember to like and subscribe to the channel. Share these videos with your followers as well as with other trading communities. Let's build a trading community together.